Happy Friday, everybody. Another week comes to a close, and another month comes to a close, and the end of the year, we can see it in our sights. I hope you had a great week. Today is December 2, 2022, and this is your Friday planning video. There's so much going on, and I don't want you to miss the important items. Yes, the heir to the throne is in the United States. William and Kate are in the U.S., no private jet either, flew commercial. Want to bet they're not sitting in the economy section? Okay, that's enough for that. That is not a market-moving news. But with the Fed in the quiet period about to start, we heard from about every Fed head that we could get in front of a mic over the last week. So we're going to focus back on the eco data here and abroad. Stay tuned for Monday's video to delve into that topic and more. With the constantly changing world of student loan forgiveness, the story goes on. Recall that the plan was rolled out and the applications were being taken by the millions until a few states filed suit against the action. And while the Supreme Court has agreed to hear the case, they also kept the lower court decision in place, which is to stop everything for now. So no money will go out for now, and no more applications are being taken for now. We also have had the extension of the pause in required payments on the existing loans, and that's at least until June. It's a little quirky as to how that goes, but that's how it is right now. More to come on both of these items. If the past is any indication, there'll be more before this day is actually done. I'll keep you informed to the best of my ability, but stay tuned to the business news as well as the Department of Education. Remember, I told you can sign up for those websites. They will send emails on the official notices only, but if you sign up, they will keep you informed. We're now into December. I want to address two retirement planning notes today. One for the contributor and one for those who may be into the distribution phase. As in the past weeks, tales from the front line. First, the contributions. I've heard this question a lot recently. The question is, if I have a 401k with the stocks in a bear market and many stocks much worse than just the bear market numbers, does it make sense to pause your 401k contributions until things look better? This is a major it depends, of course, but in most cases, if your risk tolerance support the volatility, then you should not pause your 401k or any other investment plans. Morningstar recently did a comparison of different scenarios for investors thinking about taking the pause, quote unquote. Not to spoil it for you, but the study showed significant opportunity cost while on pause and waiting for the market to feel better. These studies have shown that pausing the contributions is almost always a bad idea. I've heard this question so many times, especially over the past year or so. Quote, I've been putting money into my 401k plan 2 times a month, and after 10 months, I'm lower than when I started. Totally understand this. So just to share one data point of the outcome from Morningstar, they compared investments from the 3 major market upsets, 2002 dot-com bubble, 2008 GFC or Great Financial Crisis, and even 2020, the pandemic. The numbers were pretty interesting. For the dot-com bubble, if you continue to make $500 monthly contributions to the plan, you ended up nearly 30% higher if you kept doing it versus if you paused. Simply explained, the compounding is the key to this plan. So if this is getting harder and harder to do, let's talk about it. Remember, you're buying things for nearly 20% off of where they were last year. The exact same object, so now may be the time to add your contributions, not stop them. Regardless, this is when we need to discuss what your plan should be. As I always tell you, this is a personal decision, so it depends on your individual circumstances. As for those of you taking money out, RMD or others, there are a few items I want to touch on. With the market still down over 17% going into the end of this week, for the year, many questions have come out about selling into a bad market. There are 2 things to think about. First, if you're taking your first RMD, your first required minimum distribution, you can defer that until April 1st of the following year, which does give us a little bit more time. Remember, I don't give personal tax advice, though I am happy to discuss it with your tax advisor or your CPA. Back to the planning. But for the year you turn 72, you owe that RMD. But if you have until April 1st of the following year to get that money out. Note that in year 2 you'll be getting 2 RMDs and the tax liability that comes along with it, but it is something to consider. Another option is to distribute the amount of the RMD in kind. So if you have Apple stock, for example, just to use it as an example, and it's down, so you don't want to sell that, but you have RMD due on that account, you can make the distribution in Apple stock versus selling it in this down market and moving it cash. What this does is complete the RMD, but you still hold the stock position, hoping that in this case, the Apple stock goes back up. As long as you keep the stock, the recovery is much more possible than if you sell and hold cash. So the key here is to keep your head about you, as I tell you all the time. Some of these decisions, especially with the year-end planning with retirement accounts, they can make a huge difference. So for now, please stay in touch. We're very busy doing all the things we can as the days tick away towards the end of the year. I look forward to being in touch on these topics or any others. So have a great weekend. Please come back for the Monday market update. Remember, there's a lot going on, so we'll see you then. Have a great weekend.